The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst James Carlisle. Welcome, James.
Morning.
And the real research director, Nathan Bell. Hey, Nathan.
Thanks, Gaurav.
Sorry, gentlemen, I'm getting confused because you're both in here. I think this is the first time the three of us have done podcasts together for years, I reckon.
For a little while,
Yeah.
That's right.
Well, maybe you're getting confused because James was up until the weekend still had research director on the bottom of his emails.
Oh, maybe that was it.
I said you're welcome to it.
I
No,
did
but I've
notice
been
that.
trying to
actually.
change it, but it's all set
So is
up in
Nathan.
the system. It's automatic. There's nothing I can do. But I've told them to change
all right.
it.
I don't think
It's
Nathan's
embarrassing.
been trying to stop it.
It's been embarrassing. Oh, well, there we go.
Yeah, so we came into the office. I rocked up a little bit late today, sorry. But there was, James, tell us what happened today when you walked in.
When I walked in,
Yeah.
my tyre on my bicycle blew up. There was a sudden loud crack. I had to take it to the bike shop.
I might go to Nathan for this. The market has tanked
When the
today.
market
Yeah,
opened,
yeah.
that was a little bit after I was in the office.
My apologies. I
When
missed
the
that.
market opened, I was flabbergasted, to use the words of the Victorian health minister or something.
Is that where that came
She
from?
said, anyway, yeah, because the SPY futures. I mean, I'm not very good at reading all these futures and things, but but they'd been down 1.5%. That's what I was expecting, and then suddenly the market's down 4%. So yeah, I was flabbergasted.
I came in a little flabbergasted because I had read on the way in today that oil had fallen 20% in one session, which
That's
I
flabbergasted.
I have never seen that before. Not even during the GFC where there was a proper demand crunch. I never saw that. I thought she thought it was a typo. I thought, oh, idiots, must be 2%, and someone put on an extra zero. And I went and checked, and it was actually it fell 20%. So oil
Well, in addition,
stocks,
the oil price is not exactly at a high already.
yeah, that's right. Well, it's already fallen such a long way, and to fall that much in a session is almost capitulation.
Is this just the spot price? So if you buy oil
Yeah.
for 1 year delivery or something, is that fallen as well? Is it,
There's a curve for oil, yep, but I haven't checked the curve. But the spot price, yep.
but is
fell-
it
fell
just there's a
20%.
there's a short term supply sort of problem? Is that what it is?
Well, the oil price doesn't necessarily reflect demand and supply all the time because it's a financial instrument as well as a real instrument. You can trade on it, so it really bounces around with trading activity as well. Now, over the weekend, there was a meeting between the Saudis and the Russians to try and agree to cut supply because demand has clearly fallen, with China being basically shut down for a couple of weeks. But there was no deal forthcoming, so the supply has not changed. Demand is
Demand's
low,
off, yeah.
and small changes in demand and supply do make a big difference to the oil price. On top of that, you add the trading activity, and you get it. It's quite easy to understand when you think about it how it can fall 20% in a session.
Can't you just, if you've got the oil, wouldn't you just sort of leave the
Yeah.
barrels in the car park?
You'd think so, right?
and
Yeah.
then, rather than sell them at a 20%
Oh,
discount.
this is Charlie Munger's view of the US storage of, oil inventory anyway, and their long-term assets. They said, why should we be selling it
Yeah,
at
doesn't
these
degrade
prices?
in any way at all, does it?
It
It's been
does.
sitting there
I
I think it's quite hard to
millions of
store
years.
though. You have to. It's hard to store
Yeah.
a lot of oil.
So this actually happened during the GFC. There was the coastlines of major ports were filled with tankers just sitting there in storage, and it had this weird situation where the oil price was tanking, but storage rates were actually rising because people were doing, as you suggested,
Yeah,
James,
right.
just trying to hold on
Just
for a
hold
bit
it on
longer.
because that curve,
Yeah.
price curve. you
The
were
price
talking
curve,
about,
that's
yeah.
right. But you eventually get to a stage where you just need cash to pay your bills, and so there's a limit to how often you can do that.
I thought Friday's session in Australia was that was the first time that actually felt like a lot of capitulation selling to me. It just felt like everything was getting sold except for CSL, as always. But it just felt like people weren't really discerning between different businesses. But this morning, it's not just oil companies that have been hit. The travel companies now have fallen dramatically. I had a look on the weekend, I went and had a look at a lot of the listed companies in airlines in America, where there's a lot more than here. I had a look at the cruise companies, and just the last few days, the share prices have just completely just headed straight south. It's just a straight line down, and I feel like that capitulation selling. And I've literally got we'll talk about the portfolios and our recommendations at the moment, because I think that's what most people want to hear about, how it impacts them directly. But it's not this. When we spoke just before we came in here with these falls, I actually had the hairs on the back of my neck were standing up. This is the first time I've actually been really excited about the value that's potentially on offer, maybe now and over the next 6 months, for probably 7 or 8 years. I just feel like that capitulation is we just haven't seen that for a very long time, and because prices and valuations have had to come down from such a high start, now these travel companies, I mean, Flight Centre, maybe we'll talk about this, but balance sheet's rock solid. The earnings aren't rock solid. I mean, if things slow down, it's going to get hit. But we've seen this company go through this a number of times, and for a value investor, and also I should say, there's a couple of companies we own that recent results have been excellent, and I think they're improving and getting better. And this is, maybe there's a short-term impact, but when you start seeing share prices go south and potentially the business going the other way, like, this is what you start getting excited about.
I love the smell of panic in the morning. That's it. The one that's actually, because one we were disappointed. We looked at it, zero.
Hasn't moved?
It had barely moved. It was now down 6%, now down $70.
Yeah.
Trouble with that is that it does need to get quite a lot cheaper for us to be interested. But the quality stocks, this is interesting. The thing that happened during the GFC is that you started off with a lot of the rubbish being sold, with the heavily indebted rubbish, and then the quality stuff started going down as well, and ended up going down almost as much, I think, in some cases. Because people are sort of trying to raise cash to buy the other stuff, and so in the end it starts being fairly indiscriminate, and I think that the quality is at times like this it's a good quality matters more than.
Well, it's interesting that I've read a lot of interviews with other fund managers over the weekend, and some people have talked about the first round effects of what is being priced into the market so far, like the obvious stuff. But there was a platinum biotech analyst talking about the potential impact on CSL, and what's been, maybe this is a bit of a segue to talk about our model portfolios and funds, but the recent performance in our income fund was slightly worse in February than the market. And the main reason is that because I don't think we could have prepared this fund any better. We've had 10% cash, we had another 5% in 360 Capital, which is essentially a cash box. We've been well underweight the banks. We were selling CBA at near $90. We were underweight the iron ore companies. Well, I just feel like we've done virtually everything we could have done, because we still need to meet the yield promise on the fund. And yet it was slightly worse than the index. But the frustrating thing is the companies like CSL, which I went and measured it on the weekend, is 7% of the index, and its share price was flat during February. So it just hasn't moved. And yet this biotech analyst for Platinum was actually saying, well, you know what, this coronavirus might not actually be very good for CSL. There's a lot of panic in the healthcare system, and they might actually find they struggle to get all the plasma they need, and a lot of things will actually slow down, which will have an impact on the earnings. And I think people are herding into companies like CSL, and coronavirus has probably reinforced what they already believe about CSL, which is it's economically immune, it's growing fast, it's the best stock in Australia and whatnot. And I think that's what I think is interesting, what you're talking about, James. If there's any crack in these bull cases for these companies are trading on 50 times earnings, then we might actually finally get a chance to buy some of them.
I did see over the weekend, I was reading some of the papers, and the consensus view seemed to be that this is still an opportunity, and a lot of advice was buy the dips. This is the time to get in. And I was telling my dad about this, and he said, oh yeah, one of his friends had called him up and then told him that now is a great time to buy because there's the market's cheap. You don't get that sort of consensus in genuine fear and capitulation times. During the GFC, the time to buy was when the newspapers had gone resolutely negative, where the headlines were dire and when no one was recommending buying the dip. That's when the real fear and capitulation grips the market.
We may not quite.
We may not get
that,
there, but I actually think it's looking good.
I think it's a valid point, and I think it's a mistake to think about the market as being a sort of homogenous thing. We don't buy the market. I've never bought the market in my life. I mean, obviously, plenty of people do when they buy index trackers, but really, it's stocks that are interesting, and I think there are more opportunities now than there were a couple of weeks ago. But still, they're not necessarily in the stocks I'd like to have opportunities in, but one or two, definitely.
Well, let's get to those. Nathan, how are the funds positioned to take advantage of this? We know we've got a bit of a cash box, a cash weighting. is now the time to deploy it, and where are you looking to put it?
Yep. So I'll just so I've talked a bit about the income fund already, and the ethical fund has had about 20% cash, and it's really it's a really hard decision when you start a new fund as to whether you should go straight away and be 100% invested, because I've seen a lot of funds not fully invest and just missed out on these big stock market rallies, and it really hurts the performance for a long time. But I was just looking around. Was it Templeton? James, you'll know this better than I do, but said that the market peaks with euphoria, but then it ends up. I can't remember what the 4 stages were.
I can't remember. I can't remember. Was that Templeton?
And this is what I think we're talking about here is the 4 sort of stages of first the excitement, and it builds and builds and builds. I don't think there was. In people's views or emotions, there was euphoria this time, but I did think in February and early this year that was the first time I saw euphoria in share prices.
Yes.
And that's why we've had cash in the portfolios, and it's been a drag, and it can be frustrating, but I just thought there was no way I want this ethical portfolio invested 100% right now. And it's interesting, even a fund manager I follow who writes quite well in the States said he actually thought it was an absent to your duties of fiduciary duties to be fully invested at that point, and I actually thought he had a good point. Even though we're long-term investors and whatever, valuation is important. It hasn't mattered for so long, but eventually it does matter, and I felt like that was sort of clearly obvious that when I see CSL at 50 times earnings, that to me is just saying, look, this has gone way too far, and no one wants CSL to go up more than me because it makes my old recommendation look better. But I just think that's, if you're looking for someone ringing the bell, I thought CSL at 50 times earnings was arguably it. But anyway, the ethical fund, there's probably some stocks we're looking at, but I think the sorts of stocks that we want in that fund that sort of tick those ESG boxes, they're not the ones that have got cheap. So I'm not in a rush to we're not in a rush to put that 20% cash to work. I think it takes a bit of time for the earnings to actually show the effects of the lower oil prices and the travel coming down and whatever. So you don't have to be the first person to get into these. The momentum in these stocks at the moment is just all one direction, and it's going to take a little while for confidence to come back. And so I don't think we need to be investing today. The growth fund, which to me is the one that I measure our skill as a team on, because it has the least restrictions, so it doesn't have to tick the ESG boxes. We can just about invest in anything subject to liquidity, and it's been hurt a little bit recently by some of our larger holdings, so the Ordinates, Frontier, Lavisa, but RPM Global's another one. Most of those companies are quite illiquid and quite small, but I really see some of those names as being the backbone of the returns for that fund for a long time to come. So I have no intention of selling any of those shares at this point. Particularly the first 3 I mentioned. Obviously, Lavisa is a lot more cyclical than the other ones. But we've got 15% cash in there and another 5% in 360 Capital, which I sort of consider a cash box, even though you don't really want to think of it as cash, because the time you go to reach for it, the share price will be down. This is an important lesson in investing. But I think we're as well prepared as what we could have been. So don't necessarily look at the underperformance at the moment as saying we've taken more risk. I don't think that's the case. I think we've actually been quite conservative and ready for this. But in terms of actually putting the cash to work, particularly with the income portfolio, I think income investors are really being shortchanged at the moment. There's not a lot there to choose from. Like Transurban hasn't moved, Sydney Airport's down a little bit, all these sort of big names that you want. The banks, as I wrote the article last week, I don't think they're particularly cheap at all.
Although, you know what does look really cheap, which I almost struggle to find an explanation for the price fall, is Tabcorp.
Yeah.
That thing has just, it's fallen about $1 a share in the space of a couple of weeks on no news, really. The result wasn't great, but I think the investment case that we've outlined it still makes a lot of sense to me.
And lotteries should be fairly economically immune.
Yeah, you'd think so.
The internet is not going to slow down in terms of the purchase.
That's right. I think people keep gambling, don't they? During
Maybe more.
Maybe more. Yeah.
JC, question for you. Nathan just outlined how the portfolios are quite well positioned. Do you think this is a time to follow the fear and panic into those sectors that have been hit the hardest, the energy, the travel, and the tourism sectors? Or do you go and buy the quality that hasn't fallen quite as much?
Well, I tend to stick to the quality. I think the thing is you look at stocks that, you have stocks on your watch list that you like, and you see that they've fallen, and you try to match the fall against what has happened. I mean, things have changed. I mean, Ordinate's a great example because there is no doubt it's right in the thick of it. Its supply chain goes all the way around the world. The chips that go into its products alongside its own come from everywhere, and so there's going to be a big hit to volumes this year. But what I would say, and I did say in our update on Ordinate, is that this year's valuation, the volumes this year, really mean nothing to the valuation of Ordinate, and so I think it's a good example of a stock that's hardly going to. I really see very little of long-term effect on the company from this coronavirus. So you've got to think through the implications. I mean, look, some travel stocks, they could have a much more long-lasting impact, especially if they got a bit of debt, something like a Qantas, which certainly isn't on my watch list. But you've got to just think it through, and you've got to. So your valuations, I think, even for Ordinate, I'm going to notch down my in my mind the valuation for that stock by 10% possibly, but it's down 30, and so it's to me looks like a good opportunity.
Qantas share price probably going up with the low oil price, has it?
Yeah, well, I disagree with both of you guys about Qantas, actually. I think it's one I had a bit of a look at over the weekend, and I think we've done it in a session. We've been in a development session. We've had a close examination of Qantas. I think it is a better business than what most value investors give it credit for, because so much of the earnings come from that points business, and it's got a domestic monopoly, basically.
We concluded we didn't like it, though, didn't we? I think we all looked at it. Well, we liked the points business, but it wasn't enough.
But I think at the time the share price was at sort of $7-8, maybe even $9 at the time. It was quite high, and now it's maybe
Virgin
$5.
Chance of going broke.
I think it is.
I think it is. Yeah. I think it is. Whereas the Qantas balance sheet is extremely strong. They've actually returned about a third of the entire capital base back to shareholders over the last couple of years.
Is that a good idea? Is it that
well,
strong?
we're not carrying that much debt. I mean, and I think the if they can get some rationality into that international pricing, which has been happening around the world, that was the weakest point of Qantas. The rest of the business is actually not too bad and earns reasonable returns on capital. Anyway, but that's just here and there. Nathan, it sounds like from what James is saying that the choice whether to follow the panic or to follow the quality is really a personal one. What does that mean for the portfolios? If it's a personal decision, what do the portfolios do?
The portfolios, I think because they're aiming for such different things. I always think about what's the biggest advantage that we have as investors, both personal because we have a membership service, but also the portfolios we manage because they're still quite small by funds management terms. So the ethical funds, $20 million, the growth funds, $13 or $14 million. So I just see them as there's a real opportunity to buy stocks where people aren't thinking about the next 5 years. And I think this idea that liquidity and illiquidity is a double-edged sword. You can get crucified in a bear market by holding a lot of illiquid stocks, and we own a couple, but the portfolios are very liquid. And for example, the average market cap in the ethical fund is over $5 billion. But the stocks I like the most personally in the funds are in the funds, and that's Frontier. I mean, I've got a big personal holding in that, which has been hammered. But I just, obviously there are risks in that business just naturally from the markets it operates in. But the recent information coming out of the business has been good. We just talked about off air about Pakistan's not a global destination for travel. It's not a big importer and exporter. It's a developing country. So in terms of coronavirus, it should be the least impacted of just about anywhere. And I like it. Nothing's changed. And the recent information coming out of the business is actually it's in the best position it's ever been in as a business. So personally, I'm trying to look for situations where we can apply these advantages that we have, both, as I said, both personally and as a professional business, to the maximum effect. And I feel like I'm really personally looking for these multi-baggers. Obviously the income fund has a very different mandate. We're trying to deliver a good yield, and so I'm really hoping Sydney airports and maybe a Transurban and some of these things, even CSL, there's room for CSL in that portfolio at the right price. So like James, nothing's going to make me happier than seeing all the quality companies coming off and finally getting a chance to upgrade them like we did during the GFC. We had a pretty good record through that period.
You might get US market's down. I'm looking at it down 5% now.
Wow.
Which is a good, because the point I was going to make when you were talking to me before, is that I think the key with these things is just not to panic. You got to remember, that we're still way above where we were at the beginning of last year. I mean, the market's where it is. It's chosen to fall a long way today because various stocks have been hammered, the oil price and all that. But it's not. You don't want to be rushing into any certainly not selling decisions or buying decisions. You just got to weigh it all up, and just look rationally. The market rose 5% in January, didn't it, or something? I mean, it's been very strong recently. So this
middle of February, very.
If that didn't cause you to make many moves, then neither should this. So it's all about staying calm and rational.
Gee, that's very sensible. I must say, I panicked early. And when this hit, I mean, we talked about this in the last podcast, I sold a couple of holdings that I thought were at high risk. Danaco, which owned debt and was a crappy business run by pretty poor characters, I got rid of that instantly. And MMA Offshore, which I always said was either a 10-bagger or a zero, and I thought, if China shuts down for a couple of weeks, this is more likely to be a zero than a 10-bagger. And so I sold that as well.
But when we had that conversation, this is the last podcast, 2-3 weeks ago. I mean, the market was still pretty high. It had fallen 1% or 2%, but the market was it was pretty easy finding things to take profit in. I took a little bit of profit in REA Group, and I've actually since bought it back.
You bought it back,
but probably wish I waited a few days. but look, I mean, these are big moves. I mean, I bought it back for 20% less than I sold it for. But I mean, I think the thing is you've got to see what position sizing you're happy with, and as that stock goes up, the position sizing gets a bit bigger, and you think maybe I'll shave a bit off, and as it falls, it gets a bit smaller, and you maybe think I'll add a bit on, and so. I think you've got to have an eye to the weightings and the position sizes you're comfortable with in each stock, and look for opportunities.
So let's talk about our personal portfolios a little bit and how we're reacting to this. James, it sounds like for you this is a opportunity you've been putting on positions.
I mean, I was selling a little bit into last year, in fact, even so I missed out. I mean, look, my portfolio was already at the smallest it's been for a year or two. And so I am looking to sort of find opportunities, build it back up. Hence why I was sort of taking a bit of profit in REA. The other two stocks that I've added to, they're not new stocks to my portfolio, are Ordinate and Altium. Altium's another one where I don't really see why it should be terribly affected. The Altium is all about what happens 10 years from now, and it's a very solid balance sheet. It's in no danger of needing capital or anything like that. So I think those sorts of stocks are where you can find good opportunity.
I must say, I'm getting Nathan. We'll come to your portfolio in a sec, but I'm getting more interested in some of these really torn down panic areas. I think things like Flight Centre, Webjet, Energy. I think Energy, if there's one area that will bounce back that probably isn't affected by behavior, it's Energy. I'm nervous about travel as an industry because I just think sometimes it takes time for people to resume their normal behavior.
But not 5 or 10 years. I mean,
probably not 5. Not 5 or 10 years.
The value of these companies is very long. Well, as a long-term investor, you can look through what's going to happen. I mean, certainly, if you're on a P of 10, you lose a year's profits. That's that's going to be 10% of your valuation. So I mean, look, it can for cheaper stocks, it can be significant. But for growth stocks, it matters much more what's going on 5-10 years, and so I think, growth stocks that are well capitalized and there's a very good justified growth story. I mean, that may be why the zeros of this world aren't going down so much. But
and the other thing that's hard to anticipate is the regulatory response. So I suspect actually airlines are probably going to get a leg up from authorities and governments, just the way the car industry did during the GFC. This is a
how do
real.
They do that? Do you do cash for clunker aeroplanes or something?
I think you just give them loans. I think you just hand over billions of dollars to
just give them
airlines.
the money,
I can see that happening. But I am worried about sort of the longer term changes in behaviour. I think, Nathan, you pointed out to me, or maybe it was you, James, one of you guys mentioned to me that during the GFC in the UK, people tried Aldi for the first time to save a couple of coin, and they realized that it was perfectly fine to shop at Aldi. And that was the beginning of Aldi's big march towards greater market share. It was a change of behavior that was prompted by a short-term shock, but then ended up being like a long-term impact. And I think I'm worried about those sort of effects rolling through the travel industry. I think cruises, for example, I think they're almost gone. Like, who is going to go even after this coronavirus is
Some people
is
love them.
finished?
Some people love them. I mean, that's the thing,
But everyone knows now that they're a germ factory.
Well, but they were that before. I mean,
but people weren't aware of it. People weren't aware of it.
They've been getting terrible gastro out of cruises for a long time.
Perhaps you're right. But this is what I'm just concerned about. And I also think something like sanitization products. People, once they get into the habit of washing hands and using sanitizers, I think that habit just sticks. I mean, I'm still going to be... I didn't know how often I touched my face and how often I did not wash my hands. And I'm changing my behavior a lot. And I don't think that's going to change even after all this goes. Nathan, tell us about some of the stuff that you're concerned about and what you're doing in your portfolio.
Yeah, so I think if I was 10 years older, I would probably be looking for some of those bigger names and just maybe, I guess, taking on less risk. But that's, we all define risk a little bit differently. A low price can cover a lot of sins.
Yeah.
But I'm just turned 44, and as my twins kept reminding me on the weekend, I'm very old. But I'm still in a stage where I'm spending a lot of time. I spend all day, every day, 6 to 7 days a week on my portfolio or intelligent investor portfolios. I love what we do. I'm really getting excited at the moment about what's going on. So given that I'm spending so much time on it, like one of the lessons for me of the GFC, and some people were saying this, but a lot of people were just focused on the big blue chip names that they knew, and that actually wasn't where the value was. Like the value was in Flight Centre at $3.70. You've made life-changing returns from buying some of those more cyclical things. And one of the points I made in the February fund reports, which I published last night on our website, was just that I feel like for the first time, some of the cyclical names to me, maybe we can talk about Woodside, which has been punished this morning. These are starting to look to me much better than the CSLs. Before, I was much more happy to be in those healthcare names. They were growing fast, but even ResMed, as I think last week, its share price has actually gone up since the coronavirus. I don't know what people think they're going to buy more masks or something, but it's at 40 times earnings, and I'm trying really hard to be a long-term investor and hang on to these stocks because it's a core holding in the ethical fund, in our growth fund. But in the ethical fund, we haven't even owned it for 12 months, so we don't even get the capital gains discount yet. So I'm trying hard not to sell it. And it is economic immune. It's growing fast. It ticks all the boxes.
Well, it could have supply chain issues. I'm just wondering. I mean, they've got to put components into that. I mean, they make things with chips and whatnot. I mean, they've got to source those from I don't know where. I mean, that's the
absolutely. So I'm thinking at 40 times earnings, like my gut instinct is telling me, sell. Like it's time to start buying some of the more cyclical things, because if Flight Centre gets down to $15 or something like that, or maybe Woodside at 20, unfortunately we went a bit hard too early, as it turns out, in the income fund. But I'm starting to feel like I'd rather own those than CSL at 50 times earnings, where the business could continue doing exceptionally well for the next 5 or 6 years, and you might not make any money. And people say they're long-term investors in these great businesses, but after 2, 3, 4 and 5 years of going nowhere, even though the business is doing great, and I wrote this in the fund reports for February, but CSL is almost priced like Microsoft was in 99, and it took 17 years for Microsoft to regain its share price. And I don't care how long a long-term investor you think you are, you haven't got 17 years in you. And Microsoft is a better business than CSL in my view. And I just think that's the situation we're at now. So I'm starting to think more what's been punished the most.
Flight Centre in the GFC, I mean, it was up 4 or 5 times within the space of 6 months, I think, from memory. And you're not going to get that from a CSL right now. The thing about it is, though, and I don't think you're going to get it from Flight Centre either. That's the I should stress that. I mean, the difference is, I think, that then when you were buying Flight, it was cyclical, but it was quite high quality. I think the quality in Flight Centre has gone down a bit because the internet has advanced a bit, and that sort of mature, consumer travel business is is not as strong as it used to be. So I think some of the gloss has rubbed off Flight Centre.
Interesting, I think the US business though, the executive or corporate business is far better now than what it ever was back then. So everyone's focused on the Aussie leisure, but it's a bit sort of, I think it evens out. I actually like the prospects. The reason it's in the fund, even though it's only a small position, is because of that US business, because they actually they think they can be the largest travel business in the world. And it's much more profitable being in those corporate businesses, helping them out, than it is selling airline tickets.
But if I've learned one thing from watching Flight Centre, it's that it can fall a whole lot further.
Which is why there's no rush.
Yeah, I mean, because it's got high fixed costs, and the earnings can disappear very quickly. And in those times and when there's negative sentiment in the past, it's just kept grinding downwards. So I think these are times where, as we've said, patience really is a virtue. You just got to get your numbers sorted out. And
I do worry that it is going to be a bit different this time. Famous words. But I was speaking to a neighbour of mine who works at a big, Pfizer, the world's largest pharmaceutical business. He's a senior manager over there. He was saying that the entire company has cancelled all international travel, all of it, for everyone, and they've installed video conferencing worldwide. I just think, are they really going to spend as much money on travel next year as they did last year?
But they will in 5 years' time.
You think so? I don't know. I think once people get used to a new norm, your habits start changing. It's hard to get someone to change the habits, but once the habits are forced to change, you sort of go into a new normal trajectory.
Try to stop drug company executives from going to a knees up in Barcelona.
Yes, no, quite right.
But
I think once you've made this investment in conferencing and people are used to staying in the same place and they realize it doesn't make that much, I think there's a risk that the volume of corporate travel does not go back to where it used to be.
It'll take a little while. I mean, it'll certainly slow. I mean, there's no doubt about that. And I guess it's all a question of degree, isn't it?
Yeah. But these are the sort of things, I think these are the second order consequences that people don't necessarily think about. And I think we're used to dealing with panics inspired by financial crises or some sort of recessionary event. And here we're dealing with a crisis inspired by a health crisis, which we've never really had before. And health impacts people's behavior. I haven't seen it in my lifetime
the
before.
swine flu. I remember there being
I
a
slept
lot of
through
similar
that. I had
conversations.
no idea there was even a swine flu. You mentioned to me this morning. I didn't even know about it.
I think we all got. Well, I think I had it. 20% of the world's population had it.
I wasn't.
I mean,
aware of that.
but it just was pretty mild. It was much milder than people think this coronavirus is going to be. So, although it killed disproportionately younger people, so it was. Look, it was different, but at the same time, people were saying the same things about, are people going to travel?
Perhaps you're right.
Sort of thing. And I mean, it's easy. We're 10 years on, and we've sort of forgotten about it.
But
and
see,
I think
was
that's the likely
the
outcome
thing is,
with
though, Jane,
coronavirus.
I was alive during that. I wasn't a professional investor, but I was alive. I had no idea there was a swine flu. I wasn't aware
Didn't
of
you
any
stop
of the
part of your
stats.
toilet paper? We had 100
Amazingly,
rolls
no.
during the swine flu, I tell you. No, we
But
didn't.
this is the first time we've had a health epidemic in the age of social media, and the mass panic you see now, and there is genuine panic all over the world, and the response of governments. I mean, Italy, a free democratic country, has locked down 16 million people. They're not welding people's door shuts the way that China is, but that's
How do you
remarkable.
lock down Italians, though? I think
I would like to see that.
Surely you do need to weld their door shut.
But the point is that I think a health event affects people's behavior more than a financial event might. I just think maybe it could be a bit different. And so I just want to put that out there.
It
that
could
this
cause
might
a
be,
financial crisis. I mean, I think a financial crisis is always going to be more serious for financial assets. Is my guess, but I think I wouldn't discount the possibility of a health crisis causing a financial crisis.
Sure.
And I think that we're sort of on our way there because. Look, I won't say it's an overreaction. I think this is a very serious thing. We've got to slow it down so that fewer people get sick before there's a vaccine, and we could save millions of lives. But I think we've also got to be slightly proportionate about it. I think that's, sure. So we need to quarantine people, but I think that quite quickly the cat is going to be out of the bag, and it's going to be.
One thing I've learned out of all this is that being rational and sensible is always the right thing, but it's not always the best thing. If everyone around you is panicking and irrational, you sitting there being the rational, calm person is probably the worst.
Well, it leaves you without any toilet paper. That's
this
what we
is the
learned
thing.
last week.
If everyone else is panicking, I mean, I mean, if you're going to panic, I mean, this is Hoff always used to say this. If you're going to panic nice and early.
Tony Shannon
Yeah,
used
the
to say
Tony
that.
Did
Shannon.
well, I got it from the
yeah,
Hoff,
well,
all right.
anyway,
But I think there is something. It's very easy for investors, and particularly the value investors, to sort of take on this Zen-like calm and always
Well,
say,
we're just being patient.
yeah, I just think there's a cost if everyone else around you is panicking and you're the only one not panicking. I'm not
You
sure.
can't tell how
that's-
much people are going to panic until
Yeah.
after they've panicked. You know what I mean? All you can do is focus on value, I think. And
Sure.
if you're focusing on how much people are panicking.
No, I'm not talking about buying
or
stocks.
if you're trying to I see. Well,
I'm talking about the way people's behavior might change and the way people are behaving towards the pandemic. I'm not talking about buying stocks
right,
here.
right.
Yeah,
But
I'm just saying.
you see, the toilet paper,
yeah.
I think, is quite interesting
Yeah.
because it to me it seems like an absolutely 100% rational way to behave. Because if you see empty shelves,
Yeah.
if you're down to your last 2 rolls and you see empty shelves, then the next time there's
Exactly.
some there, you're going to take a couple of bags.
Yeah.
You know, and that it's low cost. There's just no downside to having an extra few rolls.
I'm laughing because James's toilet paper behavior has become quite legendary in the office, hasn't
Well,
it?
I'm surprised how poorly handled that whole situation was. My wife got abused when we picked up an online order. She only got half what she asked for,
I didn't
which
get
is
any
like
from Coles
12
on an
rolls
online
or
order.
something, like not even a proper big pack, and we've got 5 of us in our family. A 7-year-old man just abused her. But you just would have thought with these just-in-time supply situations, and surely like there's a whole heap of it in South Australia, could they really not just like get a few extra pallet loads and put
Well, I
it out
think
the
they
front
have.
of the
They've done that, and those are
store
gone as
and just
well.
like say, look,
They've
there's
done
plenty
that,
here.
yeah.
But like it was very slow in happening, right? It's I'm just a little bit surprised things weren't better handled. Now supply chain actually showed a few chinks in the armour, if you like.
Nathan, are you dealing? I mean, are you panicked? Are you seeing panic? How do you think one should respond?
Yeah, look, I think the most important thing of not panicking is actually not having all your money invested. I think if you're 100% invested, which I don't think any of us have been telling people for quite some time because valuations are where they're at. If you've got cash now, or just like it's hard to draw the line for me personally where my cash in the portfolio starts and cash in life starts, because I don't have any other assets other than stocks and cash. And I've had a cornerstone holding, if you like, in cash for a while, but that also helps because the stocks I tend to buy are like Frontier are at the pointy end, to say the least. So I'm not panicked. My wife's earning better money than she ever has. Nothing's going to happen to her store. So I'm happy we've got 2 incomes. So I don't need to panic. I feel like I've been well placed for this for a long time and have probably given up a bit of return over the years for that. But that helps me sleep at night. It means I don't have to panic. So for the individual, it's like, what situation do you need to create for yourself where you don't have to panic? And what I worry about, hopefully not II people, but a lot of people have been so desperate about low interest rates, they're putting money into all sorts of yield funds that have been listed. I think that KKR credit income fund that we got questions about was it 8% in a day or something, or something like that. And people, I don't believe, have any understanding of what securities are in there or how the credit markets work. And I say that because I've been a professional for a long time, and it's hard. It's like you've got to follow this stuff, and it's all in America. That's where the real pool of these securities is. And I read Howard Marks and these other guys that are experts in it, and it's complicated stuff. So I don't understand how the man on the street can understand this stuff. So I wouldn't be surprised if there's a lot of panic in those sort of markets, and I wouldn't be surprised if a lot of people are panicking because they've been forced to make investment decisions that they wouldn't have otherwise made because of low interest rates.
Well, it's a bit like the toilet paper as well, isn't it? Because those and we saw this in the GFC. Some funds that were actually fine underneath end up getting closed because everyone starts withdrawing their money and they can't get it. They can't liquidate their holdings quickly enough, and then And if you think things are gonna be closed, then you're gonna get your money out, and if everyone's getting their money, so you get into a vicious circle, don't you?
I think the one thing that also makes me feel okay as well, and I think this is a very underappreciated, we talked a little bit about this before, but an underappreciated quality about business and your own personal balance sheet is having a good balance sheet. So even though Flight Centre, we know that the earnings are going to get hit and they've already had one little downgrade, but the balance sheet's okay. And what destroys you as an investor, a long-term investor, is when they have to raise capital at a deeply discounted rate. And that's the one thing you need to avoid, because that's permanent loss of capital. And if I look through the balance sheets of our intelligent investor portfolios, there's no gearing in these these businesses. You're looking at something like what I actually sort of some stocks I think are getting a bit interesting now is Star Entertainment and Crown. Like they're monopoly businesses. They obviously compete a little bit more about it with each other now. The new casinos are getting built, but Brisbane's getting built in Queensland. New casino for Crown in Sydney, which is obviously makes it a bit more competitive for Star. But these are businesses that are going to have their share of tourism for the next 10, 20, 30 years, and the dividend yields are starting to look all right. So I think they're getting quite interesting, and sort of just completely changing the topic here, but another stock I own is Rolls-Royce, which has just been... I'm guilty of this, and you've probably seen these charts from a lot of people, but the gap between so-called value stocks and growth stocks is at an all-time high before, or was at a high before the coronavirus struck, even worse than 1999. Now, it's a bit different because in 1999, a lot of value managers made their reputation through those following 2 or 3 years. Even an old boss of mine said you could buy Honeywell, which is a very well-regarded defense business in the US. He said you could buy it on 4 times earnings. Now, I think today's sort of rhymes with the technology stocks, but you're not able to buy these great businesses for 4 or 10 times earnings. That's what's different. But there are some stocks out there that I think, because the revenue's not growing well, or they've got temporary company-specific problems, of which Rolls-Royce is one, and it's been a graveyard for value investors for about 5 years. Yeah. But I think they've got an excellent CEO. I think their earnings are like a coiled spring. The balance sheet's fine. You can't, like if you're in this situation, you're an airline, you're not going to cut your order for a company like Rolls-Royce, because it's not like you just go down to Parramatta Road and buy a second-hand car like for a jet engine. If you lose your spot in line, then you might have to go like 10 years back to wait for your engine. So there's a guaranteed order book. Things might slow down, but costs have been, like management costs have been cut dramatically in that business. And that's a sort of blue chip business that is not going anywhere. It's absolutely rock solid financially. The world actually needs these jet engines. They're the best, most efficient engines in the world. And I just think this is a business in 3 or 4 years it actually could be multiples of its current price.
I've got to say, Rolls-Royce, it's been a graveyard for value investors 25 years. I think it was probably the first stock I ever recommended as an analyst.
Is that right?
In 1995.
Wow.
Yeah. That was, I think it was about $2. So it's tripled over 25 years. What does that do you? But one thing you're talking about, balance sheets, I think is an important thing, because I think that extends to the individuals as well. I think you need to think about your personal balance sheet. And what I always think is that if my portfolio is at a point where I'm just as happy for it to go down as up, then I think that's a good place to be, because you see it go down. Look, I'm being a little bit too. I mean, look, I'm never really that happy if it goes down, but when it goes down, you're excited to buy. You've got some resources to put in to take advantage of that situation. So if you're finding that falls are bothering you that much, then it may be that you're a bit over it. I have a mortgage, so effectively everything that I invest is borrowed money anyway, but it's with a lot of spare capacity, and that spare capacity goes up and down, depending on how attractive it is, and that's effectively having some cash. If people are wholly long, if you're a retired investor with a million or whatever it is or more of stocks in your super fund, and that's what you're living off, then the way to think about this is that the dividends out of these companies really isn't changing. You when you buy a stock, you lock yourself into a dividend stream at that price and growing how you think it'll grow. And there aren't that many companies where the dividend or the growth prospects for that dividend are actually affected greatly by this. It's all about how that's valued. So it really makes very little difference to the income you can get from your portfolio.
Yeah. I think, just one practical point too, which I am thinking a little bit about for our funds, is if you've had stocks where everyone, particularly in the 11-year bull market, and we talked about Doneco and a couple of these other little things that I have as well, if you've got these little mistakes in your portfolio where you're actually sitting on capital losses, this is probably a pretty good time, if you haven't already, to sell them, take the loss. I know a lot of our members aren't taxed, so the tax issues don't affect them a lot. But if you can sell these sort of things and just take the money, you've got a little bit of cash now. That can be an easy way to get a good risk-free increase in your after-tax returns, give you a little bit of cash, which helps you feel comfortable now, and you can actually go and buy something you actually really want to put a decent amount of money into.
Yeah, I've thought a lot more about opportunity cost in my portfolio because in the past, I think I've held on to stocks just for a long time and exercised patience on every single holding to the same degree. And I've said before that some stocks are allowed to have more patience than other stocks. And so the stuff that has lots of debt, I'm okay to buy it, but I'm also going to be much quicker to act on it if something goes wrong. And that's why I was very fast to sell MMA Offshore, which I still think it's it's the result was actually quite good. It's still a potential 10-bagger, but only if that oil price goes up and stays up.
Maybe it's a good segue. I don't know whether you want to leave it until you've actually written your review, Gaurav,
Yeah.
but Woodside's probably the biggest active recommendation for us. It's been hurt the most this morning.
Yeah.
Any initial comments?
Well, Woodside does have a small oil division, and it sells some of its LNG output on spot markets. Oil prices do matter. It's not as though this is a completely irrational fall. But having said that, this is a business that that sells mostly on a contracted basis, and so spot prices falls in the oil price won't have a huge long-term impact on its valuation. What you're seeing today is really a result of sentiment. I mean, it's an automatic reaction. Oil prices fall, oil stocks fall. I don't think this ought to concern anyone, really. Woodside has a rock solid balance sheet, probably the best balance sheet in the entire industry in Australia, and it's got some of the best growth prospects of any LNG firm in Australia as well. I think that buy looks more attractive today than it did yesterday. And if we weren't already, well up there in the portfolio allocation, I'd be recommending adding some more.
Well, it's probably a consideration for the growth portfolio now.
Yeah, I would say so, yeah. I would be more concerned about things like Santos that still carry a little bit of debt. I think Origin still carries a little bit of debt, and debt just becomes more of a problem as the oil price falls and your revenues start to decline. Oil search is a whole different basket because there's a whole lot of things happening in Papua New Guinea that may have changed the game for oil search. I've been thinking about those a lot, and so far I haven't really decided how to weigh those up. But that's going to require an article at some point as well. But we're in the best, safest, and most conservative energy business in Australia, and I think that's a pretty safe place to be. For me, energy is one of those areas now with coal prices and oil prices and LNG prices just plummeting. This is a good place to sort of look for opportunity if you haven't done so already, because we learned from the GFC that those pinch points are the ones that bounce back rather well. And I've expressed some fears about travel and how people's behaviors might change. The oil is completely unaffected by that. At some point, economic activity will come back, and the oil price will go back on its merry way, the way it's been going. So I'm not really concerned about any lingering impacts, and I think this is actually not a bad time to be looking at this area. Very quickly, we should just mention one stock each that we're kind of looking at. I think we've done that anyway, but let's do that for formality's sake. JC, here we are. There's a panic. Wouldn't call it a crisis just yet, but what do you like? What do you have your eye on?
I'd love Zero to get a bit cheaper, but that's got a long way to go.
Yeah.
Webjet's one that I'm looking at more closely, so keep an eye out for that. And Altium Ordinate are two that I've already topped them up, so they've got to get a bit cheaper before I top them up again. That's personally, but as a publication, we're also looking. Ordinate's already a buy, but Altium is when I wrote about it a few weeks ago, we said below $30. Now
It was $40 back then, wasn't it?
Yeah, it was. Yeah,
Amazing.
So the valuation, has been impacted a little bit by this. It's foolish to suggest that it hasn't, but so we got to go away and do a few more sums on that. But it's beginning to look a lot more attractive than it was at $40.
Yeah, I would largely agree with that. I think some of these travel stocks, Flight Centre, Webjet, it's probably worth starting to look at these. I'm not really buying them yet. I think we can be slothful and slow in accumulating. But yeah, I also agree that Altium is one that I've got my eye on. Xero would be great to buy, but I agree that valuation still looks silly to me. One thing that looks kind of interesting is AMA Group. We wrote an ideas lab on this, and it's the crash repairer of default in Australia. They're probably carrying a bit too much debt, and I think there's a risk of a capital raise here. So that's one to watch. If there is a capital raising and that balance sheet gets repaired a little bit, this will be interesting time to look at that. I've also made an effort to try and buy businesses that I want to invest alongside. Businesses that have really good cultures and very strong managers. Two of those would be Mineral Resources and PWR. Now, so far, we haven't really... I'd add another to that, Macquarie Telecom. Those three businesses all have wonderful operating cultures, wonderful owner-operators, and terrific track records. We haven't recommended any of them, although I own a couple in my personal portfolio, and I think this is the kind of environment where those three stocks would be... I'd be very happy to upgrade them at the right price. So I'm watching those. Nath?
So I thought I'd try and be surprising, and I'm actually surprised I'm saying this, but one where we sold and ceased coverage of recently after the investment case changed quite a lot was Smart Group. So this is the salary packaging and leasing company. That said, it still has some, even though the investment case changed, and I won't go through the details here, but the fact is it still does have a lot of actually very positive attributes, and it's definitely not going to need to raise capital. It's full of cash and pay special dividends along the way, and it should be fairly immune from broader economic issues. It has company-specific, like regulatory issues that might reduce its earnings a little bit, but in terms of that broader stuff, it's actually should be fairly immune because not completely immune because people are not buying new cars like they used to, and that's more profitable for them. But the end client or the end customer, healthcare employees, and so nothing really changes in their lives when you go through a recession, if you want to say. But the stock price has come down, I think, about 17 or 18% since that downgrade. And even if the worst of the regulatory outcomes were to happen, I think it's probably only on around 10 times earnings now. So that's one where I actually think might be getting pretty close to actually putting back on the buy list.
Nice one. Okay, a couple of ideas to look at there. And we'll be publishing regularly, and we'll have updates on some of the madness should it get any worse. Gentlemen, it's great to have a podcast together. As I said, I think the first time in years since we've all sat in a room together, done a podcast. So it's great. James, thanks for your time today.
Pleasure.
Nathan, thanks very much for being here.
Thanks, Gaurav.
Everyone else, thank you for listening.